Coming up today, stocks close higher. Are we seeing signs of stagflation? Is the economy on the edge of a recession? What the godfather of AI just said, where Goldman Sachs thinks to invest, the latest crypto play from Dan Ives, and everything else to get you prepped for what's coming next. It's going to be a good week, guys. Let's go. And welcome back, everybody, for another week on Wall Street. Off to a little mixed start here today. It was the AI trade actually picking up a bit. Broadcom, Palantir, and Oracle leading the charge today, helping to push the Nasdaq higher. And I'll show you later on in this video what other hot small cap stocks are moving up there today, as we do have a pivotal week up on deck in financial markets. After the super weak jobs report last week, US economy only added 22,000 new jobs for the month of August. It's now almost certain we're going to get a rate cut when the Fed meets next Wednesday. But before that, we get the important Consumer Price Index CPI print this Thursday, the latest read on inflation, which, just like the jobs market, plays a big role into the Fed's decision on what they're set to do with interest rate. With fears brewing that we could be heading into a stagflation scenario, and that's when economic growth grinds to a halt, but inflation keeps picking up. Keep in mind, it's very rare, only happened less than 4% of all years. We really saw it back in the 1970s. And back then, commodities were the real leader, just as they've been breaking out of late. So no doubt, there is definitely some price action in the market to suggest potential worries are building of a stagflation scenario. Because typically when we see jobs growth fall off, that usually aligns with economic growth. And there has been a clear, steady downtrend in the amount of new jobs the US economy has been creating each month. And just looking at market pricing here on Polymarket, currently the consensus is we should come in at a similar level, between 25,000 and 50,000 new jobs created next month. But more importantly, how big of a rate cut are we going to get next Wednesday? 25 basis points, or are they going to go big with a 50 basis point cut? Just looking at the price action in the bond market, yields fell quite a lot last week. We now got the 2-year under 350, and even the 10-year pulling back as well, potentially suggesting the bond market is worried about the economy and that we shouldn't get a hot inflation print on Thursday, because if so, that would surprise the bond market and would likely see yields spike again. Economists in the market think inflation should print 2.9% year-over-year growth. I actually just added in a hedge today in case it comes in at 3 or higher, because if it did, that would significantly reduce the chances that we do see a 50 basis point cut. And I'd say that's the last piece of data Jay Powell and his team are going to look at for deciding whether to go 25 or 50. My thoughts are if CPI comes in at 2.9 or below, we could get to a 50-50 situation where they're going to do 25 or 50. However, if it came in at 3 or above, I'd say it's almost a lock we're going to get a 25 basis point cut, and it'd have to come in super hot, like above 3.3 or 3.4 for them to consider staying on hold again. And so since the odds of a 50 basis point cut shot up there a bit today, I took some profits off the table on a 50 basis point cut, in addition to that hedge on hot inflation as well. And I've also still got a position on a 25 basis point cut. But right now, it kind of all hinges on CPI this Thursday. So if you haven't already subscribed to this channel, click capital, and I'll keep sharing with you how I'm playing the all-important interest rate decision next Wednesday. It's not just here on Polymarket. That's going to have an effect, of course, throughout all financial markets. Interest rates are like gravity. Goldman Sachs thinks it's going to come in a little hot. They think we're going to get 0.37% increase month over month. Most economists are around 0.3. And Fed Fund futures are pretty much still 90-10, 25 basis point cut versus a 50. But will Jay Powell indeed be too late? Jobs market printed actually negative growth back in June. Showed a loss of jobs. Got to remember what the Fed does can take months to propagate throughout the economy, especially with Jay Powell fixated on lagging data. Whatever they do is going to be way behind the curve. And typically when unemployment spikes, it can spike hard and fast. And so we're kind of getting back to a similar scenario to Q3 2023, in which the data and the headlines pretty much convinced us all that we're on the verge of a recession. However, this time the jobs market is actually weaker, Q3 2023. That was more to do with the yield curve inversion, which has gone on a record stretch for how long it's been wrong in predicting a recession. But just looking at what some financial advisors, fund managers, and other analysts are saying for what their clients should do in this situation: build and preserve liquidity. Cash is your lifeboat. Focus on the things that you can control. Reassess your financial plan, explore your job security, move some percentages of stock holdings to fixed income or cash. Focus on buying appreciating assets. That's a good one. Why didn't I think of that? Create a disciplined monthly budget. Do a full review of your current portfolio. Don't panic, do nothing. Not saying I agree with all of those points, just sharing with you some of the narratives going around the financial community at this point in time. Or could we be on the cusp of something different? We just heard from the godfather of AI, the guy whose research literally led to the creation of ChatGPT. Geoffrey Hinton said AI will create massive unemployment, make the rich richer, and rob people of their dignity. Because even though we're likely to get universal basic income, he believes that won't bring people a sense of satisfaction, which I guess he does have a point. The desire to feel like you're contributing may disappear, but this is a very, very long trend. I'm not saying we can't have another recession in the economy and bear market because of AI and robots taking over, but it could be the start of that long secular trend. We are seeing many businesses laying off staff whilst still accomplishing more. In fact, I caught up with an old mate I used to work at an investment bank with over the weekend, for which he still works there, and he was telling me they're significantly investing in AI. It's doing a lot of their support, and in fact, the division he's in, they've currently got 4,000 staff. Their goal is to cut it in half while still achieving more, thanks to AI. And so maybe it's a bit of a transition in the economy into that new world of AI and robotics. You could kind of say we've already been in it for a few years. Persistent signs of weakness in the jobs market, millions of consumers, whilst the stock market and innovation continues to power ahead. As we're right on the cusp of two big ones, with robo taxis, not to mention Tesla's robo vans, and of course, humanoids, the Optimist bot. And Tesla is scaling robo-taxis at lightning speed. I'm a little worried as an Uber shareholder with some of the latest posts I've seen across social media this weekend from a number of people saying they've been catching robo-taxis for a fifth of the price of Uber. Another one showing a comparison with Uber and Lyft. Robo-taxi was 58% cheaper for the same route, and this one as well. Tesla charged me $2.92 for a ride that Uber was quoting $12. And that's why I continue to remain a shareholder of both Tesla, Uber, and Google Alphabet with their Waymo unit. I still think all three can succeed, but Uber and Waymo have got their competition cut out for them for sure. And Uber already is the most well-entrenched, dominant transport platform all across the world, partnering with a lot of companies, EVs, and even Waymo as well. So I don't think Tesla's going to drive them out of business, but I do think it's definitely going to be some hot competition, as robo-taxis are undeniably the future of transport. And so we should continue to see rapid development with that product, just like we have with the Optimus robot. It's come a long way in just the last 3 years, having just released a new look over the weekend. And don't get me wrong, Tesla isn't cheap. It's certainly priced for amazing things in the near future, trading at 150 times the next 12 months earnings. But looking at the top 10 stocks in the market, their overall forward PE isn't all that crazy at 31, especially with rates coming down as well. It's still materially below the peak of the last bubble in the NASDAQ in the late 90s, when the top 10 stocks averaged 41. And a lot of people are liking NVIDIA to Cisco of the 90s, as they were kind of building the hardware and infrastructure of the internet, whereas NVIDIA is doing that for AI and robotics. But back then, Cisco was trading at over 100 times next 12 months earnings. NVIDIA's not all that crazy at 30, so we could still have further to go in this AI-driven bull market. And Goldman Sachs macro model evaluation kind of suggests the same thing. There was a big divergence between the actual forward PEs of the market back then versus their model, whereas now it's pretty much in line. And that's because these tech companies are so much more profitable nowadays in the late 90s. But no doubt we should all be careful with how much exposure we do have to American tech stocks. I'll always own some, but for sure I wouldn't have my entire portfolio or even half of it exposed to them. It's just simply too much risk for the unknown future. And so Goldman Sachs has suggested 3 areas of the stock market that are poised to dominate through the end of this year. Investors consider alternative asset management stock. They may be attractive because, unlike their banking peers, these companies' valuations never bounced back post-election highs. And these stocks could benefit from growth in both capital markets and the broader economy, as well as optimism for financial industry deregulation. Second, they see solid potential in shares of companies with high levels of floating rate debt, noting that coming interest rate cuts could mean balance sheet pressures dissipate and profitability could improve. And they've already seen that in a basket of stocks with high shares of floating rate debt. And the spread versus the equal weight has been climbing this last month. So the market's heavily betting on rates here. Third, Goldman's bullish on gold mining stocks, citing commodities' strong price growth in recent months and spot gold's 37% year-to-date gain. No doubt miners have been shining lately, outperforming the underlying commodities. They think gold still has another 14% left in it for the remainder of this year. And just commodities in general, they're advising clients to diversify into, as there's still uncertainties over tariffs, now the jobs market, and they see inflation risks because we're likely to get a very dovish Federal Reserve chairman come May next year, along with general supply and demand dynamics in the commodity market. And I'd say also a secular trend of big money rotating out of long-dated US treasuries into gold, with Goldman also saying if just 1% of the privately owned US treasury market were to flow into gold, the price would rise to nearly $5,000 per ounce, which would still be a sizable move from where gold futures are trading today at a bit below $3,700 per ounce. And there's the outperformance of gold miners versus gold. It's really accelerated this last month and a half. But gold and silver are precious metals, there's other commodities, ones that we really need for the future that are also still looking good for the rest of the year. Uranium. I just put on a bullish options position today that I share with my options members. And another area I'm still super bullish on, rare earth materials. And one of those stocks we have in our stock picks portfolio, Idaho Strategic Resources, lay claim to having the largest deposits of rare earth materials in the States, as there's currently still only one rare earth miner in the States, MP Materials, which has now got the backing from the Pentagon with a $400 million direct investment. And of course, in addition to commodities, there's other areas still performing really well in the market. Crypto and Ethereum, and just small caps in general. Large caps, especially mega caps, have been significantly outperforming. We've seen the Russell 2000 start to outperform the S&P 500 of late, and that's really been helping my stock picks portfolio. Having a great day today, up almost 3%. Thanks to a number of names, up double digits, including Planet Labs, another one we've got that was up over 40% today. And this stock right here looking really good. Life 360, they're involved in the development of location sharing mobile applications, coming out of California with an $8 billion market cap, and we're now up over 65% on this stock after we got into it after their monster earnings back in May, coming through with a huge beat. Stock's in a really strong uptrend, giving us another momentum upward thrust signal today. It's a really good sign. And now my entire stock picks portfolio is up more than 30% in time-weighted returns since starting it in June last year. And that's well ahead of the benchmark Russell 2000 Small Cap Index, which, like I said, did recently just break out of this long multi-month base versus the S&P after a long underperformance. So I am excited for what's to come for small caps going forward. They're not so reliant on the AI trade. And my stock pick service pairs really well with my new upcoming ETF portfolio service due out later this month. So make sure you stay tuned in for that, as I'm excited to begin my new ETF portfolio very soon. And I thought we'd just profile an interesting ETF today you may not have ever heard of before, the Goldman Sachs Hedge Fund Industry VIP ETF under ticker symbol GVIP. Relatively small at 377 million assets under management, holds shares in 50 different companies, pretty reasonable expense ratio of 0.45% per annum. And so GVIP doesn't invest in hedge funds, rather it uses public filings to select stocks from the portfolios of hedge funds. That's the Form 13Fs, which I profile here on the show every quarter as well, as soon as we get them released. This fund looks at that and selects the top 50 stocks most frequently appearing in the top 10 of individual hedge funds' assets. So it's looking at what hedge funds have the most conviction in to form an index of 50 stocks to stay invested in. And that's the cool thing about strategy ETFs. Instead of just all holding gold stocks or say Japanese stocks in one specific sector, industry, or country, instead these strategy ETFs adhere to a simple systematic strategy. And that's served investors in this little known fund pretty well. Just going out to a monthly chart on this and overlaying it with the S&P 500 index from the same period since it's come onto the market. Pretty significant outperformance. In fact, more than 70%. Which is definitely nothing to sneeze at. And keep in mind the S&P 500 has been on a record-breaking run since then as well, which may not always last. And just looking at what this fund currently owns, it's not all NVIDIA, Microsoft, Palantir, and the other big performing tech stocks. In fact, one of its top positions has been United Health and foreign shares listed as American Depository Receipts, ADRs. They trade just like stocks on the New York Stock Exchange, Alibaba and Sea Limited. So they weren't just replicating the NASDAQ, and they're quite well diversified. Only 22% of the fund in the top 10. And so again, I think this fund could be a long-term outperformer. Replicating hedge funds with their highest conviction bets, I think is a solid strategy. But with 2,000 plus tradable ETFs out there, how exactly do we know which ones to buy and when to sell? We're just trying to guess day to day. We'll have you chasing your tail around, constantly causing frustration and stress. Instead, I recommend following a simple strategy like the one I've developed and have been using myself for almost 3 years now, helping me to outperform my benchmark. And if you'd like to learn all about this and haven't done so already, click the link below this video or head on over to my website, clickcapital.io, and get my free ebook today. I'll show you how the global all-weather ETF investing strategy works, why it works, and why I'm investing 2 of my 7 portfolios like this for the rest of my life. Honestly, I think it's one of the most simple, low maintenance, low stress, purest ways to ensure we're always holding a globally diversified portfolio of the strongest performing assets based on the proven momentum factor. So check that out and give it a read this week if you haven't already. I'm sure you'll learn something new. And stay locked in with Click Capital if you're into building wealth using ETFs. I think they're the best building blocks of wealth for anybody, anywhere in the world. And you can kind of think of US listed ETFs, which is over 2,000 now, as not American ETFs, but rather a gateway to the world offering you exposure to hundreds of different global assets. So even if the AI bubble does completely pop, there will still be hundreds of other ETFs out there continuing to rise and do their own thing. That's why I always laugh at people who say the market's a bubble, you got to stay out. I always ask them, what market? There's no such thing as, quote, the market, unquote. I think they're just referring to the S&P 500 or NASDAQ index, which again is just one part of the world. And it's getting back to the hot industry of crypto. Got popular Wall Street analyst and now more and more so fund manager Dan Ives getting in on a hot new crypto side hustle. With a crypto treasury company, Dan Ives will be the chairman of AAPL Holdings, focusing on cryptocurrency investments. And so the NASDAQ listed AAPL will essentially be a holding company predominantly for WorldCoin, a crypto created by Sam Altman, founded Worlds, the guy who heads up GPT. They'll buy 250 million of WorldCoin initially and could hold Ethereum as well. And so no doubt a controversial industry using the equity and debt markets to raise capital and then plow it into crypto just to hold on to it. And don't get me wrong, I'm not against it. I've got shares in Bitmine emergent technology myself and have done ever since Tom Lee got into it. Also added the Ethereum Trust to my long-term buy and hold portfolio a few months ago when I made the bullish case for it on the pending Genius Act. It's done very well, but no doubt it's drawing the eye of regulators and the exchanges. NASDAQ coming out last week trying to pump the brakes and require shareholders to sign off on issuing equity and debt to buy more crypto. So this very well could cause a massive pile-on, and that's because it just works. Look at shares and AAPL holdings today. In fact, I have to go to a logarithmic chart because it's up so crazy from yesterday. Yesterday it traded 13,000 shares at $1.45. Here we are, up 3,000% today at $45 a share. Also helping to give a significant bump up in the cryptocurrency Dan Ives plans to accumulate. WorldCoin ripping up 47% there today. And just like I've been saying the last couple of months, expect to see more announcements from large financial companies looking to build on top of Ethereum with stable coins and tokenization of asset. We just heard that again today with Fidelity, one of America's largest brokers, launching a $200 million tokenized treasury fund to compete with BlackRock, who are currently leading the tokenized treasury market, already topping $7 billion. Some projections put it at $2 trillion within the next 5 years. So they just launched the Fidelity Digital Interest Token, FDIT, and that was confirmed by blockchain records and SEC filings. They didn't make a public announcement. And on top of these large Wall Street banks getting into stable coins and tokenization, also got one of America's largest exchanges, the NASDAQ, just pitching the SEC for digitizing assets for faster and seamless transactions with tokenization, after we've seen Robinhood and Coinbase making similar moves as well. No doubt blockchain technology is here to stay, and I think Ethereum is pretty much going to be the infrastructure that most of it will be built upon. Another hot theme in the market, still gathering pace, space exploration. SpaceX could very well be the largest IPO of our lifetimes, head and shoulders above the rest of the industry. Latest valuation, $400 billion. And so this could still be years away from going public and listing on the stock market. However, there are a few ways investors can gain exposure to SpaceX. EchoStar announced a deal today to sell the company's AWS-4 and H-Block spectrum licenses to SpaceX. The frequencies over which wireless calls travel is a finite resource that every mobile company needs. SpaceX will pay up to $8.5 billion in cash, and importantly, up to $8.5 billion in SpaceX stock in the transaction. The move values EchoStar stock at about $23 billion, which means the SpaceX stake, assuming the deal closes, represents more than 35% of EchoStar's market value. And so now EchoStar is composed of spectrum assets, a satellite business, Boost Mobile, and the SpaceX stake, with one analyst saying that's worth $89 per share, and that's helped to bump the stock up significantly today. Finished at $80 per share, still running a little bit after hours as I speak, and as of Friday close, the market cap was $23 billion, so it's closing that valuation gap pretty quickly. But there is another way investors can get exposure to SpaceX. I shared with my regular viewers earlier this year when I got into it myself, making it a core holding in my long-term buy and hold portfolio. That's the Entrepreneur Shares Private Public Crossover ETF. Again, a little known ETF that, as the name suggests, gives investors exposure to both public and private companies, with SpaceX being its second largest after NVDA. And they've got about 30 other stocks, along with exposure to two other exciting private companies that will IPO at some point over the next year or so: Anduril, drone technology, and Klarna, pay later platform, in addition to other leading tech companies, as they're focused on what they call the entrepreneur factor, companies that are founder-led very innovative, and that have skin in the game. And that's something that aligns with my investing beliefs as well, and hence why I added it to my long-term portfolio. As I told my regular viewers back in March and April this year, I was buying the dip and adding to the position. Now it's pretty much sitting at all-time highs, having a great recovery with the market as well. This fund still doesn't even have $500 million in assets under management. Also up on deck this week, the new iPhone 17 from Apple, set to be released tomorrow as they host their annual product event. Investors looking for new features and capabilities that could spur customers to buy, and the market can start pricing in a good upgrade cycle, as the iPhone does account for roughly half of Apple's revenue. And there's a look at Apple's stock price going into tomorrow, similar to the market, just kind of calling up here on low volatility, just like the S&P 500, just a bit below 6,500. We may get a move this Thursday on CPI, especially if it comes in hot. I think the market might sell off in that scenario. Otherwise, if it comes in at expectations of 2.9 or below, we may get a rally, so the market could potentially price in a 50 basis point cut. We have flipped back quite a bullish setup here. The main indices and risk-on sectors uptrending, whilst we've got volatility yields and oil all downtrending, especially a sharp fall-off in yields. Market really is pricing in soft inflation. It would surprise the market if it did come in hotter than expected. So no doubt it's going to be an interesting week. Thanks for sticking with Click Capital. I'll keep you updated throughout, and we'll see what headlines, data, and price action we get tomorrow. Cheers.